unfortunate news for Affirm stock investors, as it looks like the company lost its exclusive relationship with Walmart as its buy now, pay later provider. So in this video, I'm going to review Affirm stock again, updating it based on these new developments. I changed my discounted cash flow valuation model to incorporate these developments, and I'm going to bring that all together and answer if I think Affirm stock is still a buy after it lost this deal, or if this makes Affirm a investment that you want to avoid now that it lost the Walmart deal. So let's review this interesting growth stock.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so looking at Affirm's revenue growth over the last 5 years, the company has demonstrated phenomenal growth and re-accelerated that growth since 2023. Investors became very concerned as the company's growth rate decelerated considerably, and then it has since rebounded at 46.6%. That's very solid revenue growth. However, this revenue growth is going to take a hit as a result of the loss of the relationship with Walmart. Walmart is a huge business that generated significant customer acquisition for Affirm. And now that the company has lost this relationship, it's likely to result in slower revenue growth. However, Walmart has a reputation for securing strong deals with their partners and not being so profitable for their partners. Now, with Affirm, that's a little bit different because the company is not a supplier for Walmart in the traditional sense. It doesn't give Walmart products and then sell them to Walmart, and then Walmart goes and sells them to its customers. It's more of a service provider. And so the relationship could be a little bit more favorable for Affirm. Still, you can understand that Walmart, being so large in scale, has the ability to negotiate great terms with its partners. And this loss of the deal with Walmart could be a good sign for Affirm stock investors, in that the management team at Affirm is not willing to just give in at whatever terms just to secure a relationship or just to secure a sale. That's what's gotten a lot of companies, a lot of growth companies, in trouble in dealing with these large companies like Walmart and Amazon, etc. Just because of that name recognition, they go above and beyond, and they give these companies terms that they really shouldn't be giving these companies. Two specific examples are Rivian with Amazon. Rivian gave Amazon very favorable terms to sell them the electric delivery vans, and it's not working out well for Rivian. It's working out very well for Amazon. And similarly, Plug Power with both Walmart and Amazon. Plug Power is an energy provider that agreed to terms with Walmart and Amazon. That's been extremely hurtful for Plug Power, and Plug Power has proceeded to lose over 95% of shareholder value in the last 3 years. So I point those examples out because you don't want the company that you're investing in to make those kinds of deals. And this loss of a relationship with Walmart is likely a situation where that happened, where Walmart went to Affirm and said, look, unless you offer us these terms, we're going to go shopping and we're going to go look for another partner that might give us a better relationship, a better value in the relationship. And Affirm said, all right, if that's what you want, then go ahead, but we're not going to budge lower than these terms. And so for the future, that could be a good sign for stock investors in Affirm that the company's not going to look for these types of unprofitable deals. And if you look at the company's cash flow from operations to sales, it's showing up here. The cash flow from operations to sales has been jumping since 2023. It's up to 28% now. And management could be in a position where they like this and they're saying, you know, we've grown to a large enough size now. We're cash flow positive. We don't need to make these. We're not so desperate for these kinds of deals anymore. So we're going to stand firm and we're going to stick to our guns and we're going to keep this the way it is. So it remains to be seen how much impact it's going to have on the company's cash flow from operations to sales. But for sure, it's likely to have an impact on the company's revenue growth rate. The revenue growth rate is likely to decelerate in the short term. In the longer term, I like what Affirm offers both merchants and customers. It gives people and businesses a way to facilitate sales. People like it because they get to buy something earlier than they could if they had to save up. For instance, let's say you're a teenager, let's say you're 18 years old, you just got your first job, and you want to buy a Sony PlayStation 5 console, which I think is around $400 or $500, but you haven't gotten your first few paychecks yet, but you still want to buy that console. You can buy it and start playing it and then pay it off over the next few months. The business likes it because the business gets to make that sale today instead of 2 or 3 months later, where there's a chance that this buyer may find something else they want to use their money on and not buy that console. So both sides of the transaction like what Affirm offers, and I think that's going to be a tailwind for this business in the long term. And just like the cash flow from operations to sales number, the returns on investor capital have been improving for Affirm up to negative 2.1%. I wouldn't be surprised if this continues moving upward towards, it could potentially reach the 20 to 30% range in the long run, because it's an asset-light business model, especially as Affirm finds buyers for the loans that it makes, right? So these buy now, pay later installment loans, Affirm has a strong market to sell them to. And so it becomes the facilitator, the originator, and then it sells these loans and gets the capital back and makes new loans. So it's a capital light way to grow this business in a market that's expanding quickly. So the updated valuation, now that the price is down more than double digits today on this news, Affirm is trading at a price to free cash flow of 23.5, which is the lowest it's been at in the last 6 months and in the last year or two as well. So you're getting this stock at a really low valuation now. I updated my discounted cash flow valuation model for Affirm. I don't want to go through all the specific details of what I changed in my discounted cash flow model. If you want access to those videos where I go through each detail, you can join as a channel member, and I have dozens of videos of companies where I go detail step by step on these discounted cash flows. In this video, I'll just summarize and say that from my previous model, what I updated today following this news is a roughly 10% decrease in the amount of free cash flow expected for Affirm between 2025 and 2034. So roughly a 10% haircut, not precisely 10%, but roughly 10% declines. And so my intrinsic value per share fell from around $84, $85 per share down to $79 per share on an intrinsic value. But still, it compares favorably to the current market price of $45. So all things considered, I still think Affirm stock is a buy, and I think it's a buy on this dip here, although it did just become more riskier on the back of this news. But I think there's enough of a margin of safety there to still make this stock a buy, even after this announcement. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.